Hi everyone and welcome to this new video. This time we will be taking a deep dive, an objective look into HHIS ETF, the Harvest Diversified High Income Shares ETF. This ETF has attracted a lot of attention because of its promises of high monthly income, diversified exposure to US companies, and a simplified way to access covered call strategies. But like most income-focused ETF, the real question is not how much it pays, but how that income is generated and what investors give up in exchange. So in this video, I will explain how the fund works, what it owns, how income is produced, and the role of leverage and the application of the return of capital, and most importantly, who this ETF is for and who's it designed for. So what's the ETF objective and investment approach? HHIS is an actively managed ETF, meaning it does not track a predefined index. Instead of passively following the market, the portfolio is constructed and adjusted by the management team at Harvest ETF based on their assessment of market conditions, volatility, and income opportunities. So the managers make several key decisions on an ongoing basis. They determine which underlying single stock income ETF to hold, how much weight each position receives, how aggressively covered call options are written, and how leverage is deployed within the portfolio. So these decisions directly influence both the level of income generated and the risk profile of this ETF. And I find this quite interesting. So really, in this ETF, we're really relying on the quality of the management team in terms of generating and spotting those opportunities to increase income or benefit from growth. So the objective of HHIS is to combine three core elements into a single product. First, it seeks to provide exposure to large, well-known US companies, which most are really quality companies, and they are traditionally associated also with growth rather than high dividends. Second, it aims to deliver consistently monthly income primarily generated through option premiums rather than dividends alone. Third, it attempts to manage risk through diversification, spreading exposure across multiple issuers and sector instead of relying on a single company or strategy. This flexible, discretionary approach allows Harvest to adapt the portfolio as market conditions change. For example, option coverage levels may be increased during periods of high volatility to capture more premium income, or adjusted when markets are calmer to preserve some upside participation. So one of the most important things to understand about this ETF is its holding. It's a fund of funds, so it does not directly own stocks like Apple and Microsoft and then applies the strategy. Instead, it holds portfolio of Harvest single stock high income shares ETF. Each are designed to generate income from one underlying US companies. Some of these have become really popular because of the publicized yield that they have. So instead of you owning each one of them or owning just one and being super concentrated, you have the chance to own HHIS, which is a diversified basket of these type of ETFs. So each of these underlying ETFs typically follows a consistent framework. First, the ETF maintains a long exposure to a single liquid large US company. These companies are generally well established, as you can see here. It's Google, Netflix, Meta, AMD, Broadcom, Costco, Tesla. So it's all the big names. They have high liquidity, high option market, which is really good when you're trying to sell covered call. When you're trying to apply the covered call strategy, you need a very strong liquid option market for the stock, and all of these stocks have strong option markets. So they are widely traded and actively followed, which is essential. Second, each ETF will write covered call option on a portion of its position, which is great because you don't want the covered call strategy to be applied 100% because it really will limit completely the upside potential. So what they are doing is they will apply the strategy on up to 50% of the portfolio. So if they own, let's say, 1,000 shares of NVIDIA and they want to apply the strategy, they will apply the strategy only on 400 shares. So the rest, the 600 shares, you will get full potential. So if the stock goes up, you are getting 100% of the growth on that 600 shares. Whereas the 400 shares where you applied the covered call strategy, the gain will be dependent on how the covered call was set up, what's the strike, and all that. So they're flexible, so there's more active management, so they can decide whether to use at the money options, out of the money options on that portion where the strategy is applied. So it depends really on their reading of the market. Which is it could be a plus if they're really doing a great job there. The most of the income for these ETF comes from options. Obviously, none of these stocks pay dividends, and if they do, they really don't pay that much of a dividend. I think only Apple pays some dividend, but not that much. And so these companies, most of the income that you will be getting is option income from the covered call strategy. So in the enhanced series, Harvest may also use modest leverage, typically 25%. So what leverage does, it enhances the returns of the fund, but also like when the market is not doing well, it will also increase the risk for you and increase the loss. But it's modest leverage, 25%. We're not talking here about those Beta Pro ETF that have like times 2, times 3 leverage. This is 25%, so it's somewhat manageable, but you have to keep that in mind. Across all single stock ETFs, Harvest follows risk management's principle that emphasize position sizing, liquidity, diversification. No single company dominates the overall portfolio. So HHIS, they will hold those single stock ETF and decide the positioning, and they try not to have in one stock more than a certain percentage. So as a result, you're having a diversified portfolio, a basket of structured single stock covered call strategy combined in one ETF for simplicity and income focused exposure. So the core income engine for this ETF is its covered call strategy, which I will explain here at a basic level. A covered call involves 3 steps. First, the fund holds a stock or an ETF. Second, it will sell call options on that position. And third, it will collect option premium. So to make it concrete, so let's say you're buying a stock for $100. 100 shares is the minimum to start applying the covered call strategy. So if you're uncertain about the future of this stock, in a month from now, you're not sure how the stock will perform, and to protect yourself, you will be willing to sell this stock in a month from now for $105. So you're putting a cap there on how much you could win. So you will be putting a cap of $5 because you bought it at 100. You're willing to sell it in a month from now at 105. And when you sell this option, there will be someone interested in it, someone who's willing to basically pay you for this opportunity, because in his mind, he thinks the stock will be worth much more than 105. So you limited your potential growth and you get paid for it. So you get paid, for example, $3 option premium because you're willing to sell your stock in a month from now for 105. So if the stock stays below 105, you gained already the premium of $3 and you get to keep the stock. So you just got yourself a dividend or distribution of $3 without even losing the stock. And if the stock goes beyond 105, then you will lose your stock, and you will go to the other person who bought the option, and basically you sold your position for 105, so you gained $5 plus the option premium of $3, which you already cashed in when you sold the option. So you made $8 income. So this is really as a protective way. It's a way for you to protect your money. So covered call is someone who's willing to protect his stock and doesn't mind losing some upside potential just to get some income. So that's the idea. Obviously, if the stock goes to 120, you just missed there a great opportunity to make 20% in a month, and instead you just made $8, which is like 8% in a month. Many investors notice that a portion of this type of fund, the covered call ETF distributions, may be classified as return of capital or ROC. This often raises concern, but it's important to understand that ROC is not automatically a negative signal. especially in a covered call ETF and fund-of-fund structure. In the case of HHIS, the ROC can arise from several sources. One common source is option premium income. Let's go back to our example of you buying a stock for $100 and you're selling for a premium of $3 and a strike of 105. So what happens is that these funds don't manage money like the way you and I will manage their money, because they have to have a NAV, the net asset value, match what they have in the fund. So what happens is that if the stock goes down to 95, for example, you made an option income of $3. But in accounting principles, you cannot say that that $3 is a gain, because your position went from 100 to a cost basis of 95. So in accounting terms, you cannot say this is a gain. So this is why when they will pay that option income of $3 that they got, when they will pay it back to you, they cannot say that this is a gain, because in accounting principles, they cannot determine that as a gain. So this is why sometimes the percentage of return of capital for this type of fund exceeds sometimes 60 or 50% of the overall distribution. It's not something to worry about. It's just more of an accounting and mechanics. ROC can rise from several sources, as I mentioned. One common is the premium. Option premium are not always treated as taxable income when received, and may be classified as ROC for tax purposes, even though they represent real cash generated by the strategy. ROC can also result from portfolio rebalancing activities, where gains are realized and distributed in tax efficient manner. Additionally, fund of funds tax mechanics can cause distribution to be categorized as ROC, even when the underlying ETF are generating income. So it's more related to tax. However, you should always check before you buy a covered call ETF, check the graph, like how the price evolved in a long-term period. It's okay if it's not moving up that much, because remember, you're getting a high yield. So that's already like a very, very important portion of your return is the yield, is the distribution. You're in an income focused ETF. So most of the gain will be from distributions and not from capital appreciation. However, if you see that the price of the ETF is going down in a very like sharp way, continuously, then something is fishy with the ROC there. The price, like we could see here, of the fund is hovering around a mean and just going up and down, but not like excessively going down. That means that the fund is well managed and that the return of capital is mostly just option premium and not really, they're not still in position to give you your money back. So while ROC is not inherently problematic, it does become a concern under certain conditions. The most important red flag is persistent ROC combined with a declining net asset value or NAV over time. So objectively, HHIS has several strengths. First, it provides diversified exposure to major US companies without single stock risk. So it's really ideal for you if you want to invest in the tech sector, but you're not comfortable with the volatility. So you turn that volatility into an extra income, and also you reduce the volatility. Second, this fund delivers also a monthly income, which appeals to retirees, income-focused investors. So regarding the risks overall, so we can discuss the fees. It carries like the risks. First of all, we have the full equity market exposure. This is a 100% equity portfolio. So even if it says covered call, don't think that covered call is enough to protect you in a drawdown. If the market gets a correction, covered call ETF will be also impacted, because when you generate options, don't expect like the option to cover like more than 2 or 3% move up or down. The covered call, it will only cover maybe 2% or 3%. But if the stock goes down 10%, there is no covered call strategy that can protect you for that. So keep in mind that this is a 100% equity. So yes, if there is a major correction, covered call ETF are also impacted. This is why when you buy them, you have to buy them for the long term and not for the short term or not a short play here. It's for the long term because they are equity at the end of the day. They are equity ETF and they behave the same way the stock is behaving. So if the stock is getting hammered, the covered call ETF also see their gains being less and less. But if you're long term and the portfolio, as we saw, is quality stocks there, quality names there. So if you're holding for the long term, you should be okay. And obviously, if you reinvested distributions, you should be really much more than just okay, because that compounded your return during drawdowns or corrections. So the strategy obviously caps the upside during bull market, as we mentioned earlier with covered calls. There is the leverage risk for the 25% that we mentioned, and there is the sector concentration in growth stocks because even though they hold multiple single stock ETF, but if you look at the sector, tech still dominates the holdings of HHIS. The MER is 1.88%, according to my research. So it's higher than an index ETF. It's the price to pay if you want an active management covered call ETF. So it really depends on your objective. So HHIS was launched in January 2025. We don't have the full performance data yet, not available on their website. And what do we see so far is consistent monthly distribution, starting at around 25 cents, increasing to 27 cents per unit. This provides early insight into income stability, but long-term performance will matter far more than early payout, obviously. So we'll wait till they publish their performance, so then we could judge better this strategy of using single stock covered call ETF and managing them as a whole in a portfolio. We'll see if it really delivers. So my final assessment is that HHIS is not a bad ETF. It's just often misunderstood, especially with these all covered call ETF. They are usually misunderstood by people. It offers diversified monthly income from US equities using covered call and leverage. The yield, if you find the yield high, try yourself to sell an option on a stock, and you will see that the yields are really interesting when you're selling a covered call option. You could make a weekly income of 1 to 2%. Some stocks even have a weekly income just from option up to 3-4%, depending on the volatility. So it does work, but if you do it yourself, you're not diversified, you don't have enough funds to do it. So with these funds, they allow you to access that strategy, which really can enhance income quite drastically. And we see that with their single income ETF. Some of them really pay very high yields because of the how strong the option is and the volatility in those ETFs. So, but the income always comes with limited upside, higher fees, and equity and leverage risk. Just understand those. So if you find this breakdown helpful, please leave a comment. Let me know what ETF you would like to be reviewed next. You can also read the full written analysis on my web blog, wyseinvestors.com. I will put the link in the description. And if you'd like to contact, please don't forget to subscribe and like it. Thank you.